so we're going to get into a discussion about traditional IRA versus Roth IRA. So let's explain and understand the differences between each. We'll start with the traditional IRA. The traditional IRA, typically, you get a deduction for a traditional IRA contribution. There are cases where you don't. It's called a non-deductible traditional IRA contribution. We'll get into that in more complex tax planning conversations. But with a traditional IRA, the money goes into the account, and your earnings and your contributions at the time of withdrawal will be taxable to you. So imagine a situation where we put $2,000 into the traditional IRA 1 year, and years down the road, when we pull that money out, we pull $3,000 out of the account because it's grown with earnings. The $3,000 that we pull out of that account will be taxable in the year we withdraw it. Traditional IRAs are also subject to something called required minimum distributions. That basically is when you reach a certain age. Historically it's been 70 and a half, currently it's 72. You are required to start taking distributions out of that individual retirement account and essentially use a lifetime income table to determine what that distribution amount is. Those are called required minimum distributions. If you take your traditional IRA out of your account before your age 59 and a half, it is subject to an early distribution penalty, with 2020 being an exception related to COVID-19 distributions. On the other hand, the Roth IRA results in no deduction for your contribution. However, we'll see in some of the examples how it does impact your credits in certain situations. But those contributions go into a Roth account and grow tax-free forever. So it's the growth inside the Roth IRA that's beneficial, because that money is never taxed. The other unique thing about Roth IRAs, they are not subject to the required minimum distribution rules, and therefore they do not force you to take that money out once you reach a certain age. If you do take money out of a Roth IRA, there are ordering rules. You are deemed first to take the money that you contributed to that Roth IRA out first. And if you'll remember, there's no tax deduction on that contribution. So when those contributions come out of the Roth IRA, there is no tax on that withdrawal. The caveat here is if you take earnings out of that Roth IRA, then those earnings are subject to tax and could be subject to penalty if you don't meet certain requirements. So our next process is to go through and explain the tax benefits of these IRA contributions, whether they be deductible, non-deductible, or Roth IRA contributions. We'll go through a few scenarios here specific to different filing statuses, different income levels, so that I can help you understand the impact that you can have on your taxes. In this scenario, we're taking a married filing jointly couple who have $60,000 in wages and $100 of interest income to give them a total income of $60,100. From that, they deduct their standard deduction of $24,800. When that money's deducted, their taxable income is $35,300. They generate a federal tax amount of $3,841 based upon that income. From that tax, they deduct their $2,000 child tax credit for their child that they have who's under the age of 17. That generates a total tax amount of $1,841. This same couple can make a Roth contribution of $2,000. When they make a Roth contribution, you'll see that the tax credits total $2,200 because their income is in a situation where they get a retirement savers credit of 10% of their retirement contribution up to the first $2,000 of contributions made. So they have actually increased their credits by $200 by making a Roth contribution, thus reducing their total tax by that $200 from $1,841 to $1,641. In the event this couple decided to make a traditional IRA contribution in which they receive a deduction for AGI, they reduce their total tax to $921. Putting those scenarios side by side, you'll see that the total tax moves from $1,841 down to $921 by paying themselves $6,000. Now, this couple can do more than $6,000. Their IRA contributions are $6,000 per person. So it's possible that this couple could make a $12,000 contribution to deductible IRAs and actually generate a refund. Okay, let's talk about a single taxpayer and review those IRA scenarios as well. Here we have a single taxpayer with $35,000 of income, $100 of interest income for $35,100 in total income. Their standard deduction is $12,400, giving them a taxable income of $22,700. With their taxable income of $22,700, they experience a total tax of $2,527. If that individual was to make a Roth contribution for themselves, they do not get a deduction for that Roth contribution, and so their tax is unchanged. If that taxpayer were to make a $6,000 deductible IRA contribution, then they would reduce their total income and reduce their taxable income. When they do that, they put themselves in a position where they actually get a $200 retirement savers credit, reduce their tax to $1,670, and reduce their overall tax because of that credit to $1,470. So they've paid themselves $6,000 by moving it from one account to another, got the deduction for the IRA contribution, and when they received that deduction, it dropped their income down to a certain level, so they received a retirement savers credit. So they were able to take their tax from $2,527 to $1,470. Now let's review the head of household situation, where we have an individual who has a child at home who's under the age of 17. That individual has $35,000 in wages, $100 of interest income. Their standard deduction for their filing status is $18,650. So their taxable income's $16,450, and their tax then is $1,692. Because of the child tax credit and the earned income credit, their total credits total $4,438, reducing their total tax and resulting in a refund owed to the taxpayer of $2,746. If that taxpayer had made a Roth contribution of $2,000, that Roth contribution would then result in an additional credit that's owed to them, resulting in a total refund of $2,946. One more step that taxpayer could make is making a $6,000 traditional IRA contribution. When they do that, that drives their total income down and drives their taxable income down. When that happens, there is more earned income credit available to that taxpayer, resulting in a $3,814 refund. So this taxpayer has the ability between January 1st and April 15th to make these decisions and actually put money into a traditional IRA and increase their refund from $2,746 to $3,814. I hope this helps you better understand the traditional IRAs and Roth IRA contributions that can be made. and the different filing statuses and how it affects your taxes and how it affects your credits. You'll want to refine that conversation specific to your tax return with your tax planner, CPA, or proactive individual who understands the impact that you can make on your tax return. If you've got questions, there's a link below to our website where you can click Ask Questions and send us some information that you're asking about or you want to know more information on. If you have suggestions for other content you're interested in, please provide that information there. If you like the content, feel free to share this with your friends and family, and also subscribe. We appreciate your time.